Welcome to TMS Insights. Jeremy and Ben again with you. It's early into March, and we're going to start by looking back at the back half of the February reporting season before bringing you into a bit of really important world and macro events that are rocking markets, Ben. But let's get into some of the reports that we haven't covered to date. Australia's biggest conglomerate, Wesfarmers, really delivered after being a strong share price performer over the last couple of years.
Yeah, I was a bit nervous about what the share price might do because as the reporting season went on, there's no doubt this theme sort of grew of companies delivering quite good results and getting hit on the back of it. And that was definitely something we saw. Wesfarmers held on to its gains and its result was quite a bit better than analysts expected. And again, it was Kmart, was the big surprise packet, which this Anko brand that they're rolling out globally is doing very well. Improved result from the chemicals and fertiliser division, which has been under some pressure in recent years, and Bunnings was good. So that was one of probably the better quality results we saw.
Yeah, and for a big one, that was impressive. It's got momentum, certainly, as you said, with Anko and the Kmart business.
Yeah.
Let's go to the other end of the market. More one that's been in the news for the wrong reasons. WiseTech, and let's talk about its result before we talk about everything else. But the operating performance of the company, we know it's got a lot of contracted revenue, so it shouldn't be a mass surpriser, but the business is tracking very well.
Yeah, the result was pretty much bang in line with analysts' expectations, and I think when you read the analysts' comments, they're actually a bit surprised that they managed to go in line given all of the stuff that's been happening on the sidelines. But The minor negative was that three key products, the new software products that were meant to be getting rolled out and would have accelerated earnings this half, have been delayed 6 months, probably because of some of the issues there. But they're still going to be rolling out, and it's just pushed out the growth a little bit. They announced they've signed up two more of the top 25 freight forwarders onto the platform, both Japanese companies, which was big news. And I think the most important thing was Richard White fronted up and, I think we put to one side all of the issues in his personal life. We got off the call very much. He was very committed to this.
He was beating the desk.
He was beating the desk, unequivocally saying, if you are a shareholder in WiseTech, I am the man steering the ship for you.
And some will like that, some won't. But he's the guy that built the company, so purely financially, there's something to like in that.
Yeah, and he is, from all accounts, the brains behind new product development.
Yeah.
So I think we want him there.
You don't want him elsewhere.
No. Well, let me give you another scenario. He stepped back, the share price reaction would have been nasty. And it hasn't been great regardless, because I think you do have some money leaving because of the ESG stuff, and there'll be some that come on.
And there's a board in flux. That's the thing, governance-wise. So it's great, his part of it, but you still need a governable company, and that's issues that have to be resolved yet. And why the share price is lower than it ought to be. So if they could put that together, and we don't know whether they actually can, then it would be higher. There's no doubt about it.
Yeah, and look, I think you got to remember, it can be easily forgotten. This company is older than Google, and Richard started this literally from a garage, and he is WiseTech. He is the largest shareholder and controls the stock. So it's been a wild ride, ultimately a very profitable investment for us, but a lot of ups and downs, and I think it's a buying opportunity at the moment.
Speaking of a buying opportunity, we talked last time about Goodman Group, but we want to know, we've got the details about the share purchase plan. So for existing shareholders, they're offered, like the institutions had and took $4 billion of stock up in, they can buy $30,000 at $33.50. But you wouldn't, Ben, because the share price is lower. Yeah,
so share price roughly $32 at time of videotaping this. And unusually in this SPP, there's no clause where if the share price is lower than the offer price, you get a small discount to that lower price. So you're better buying this on market now. You don't need to do 30,000. You can choose whatever amount you want. But we would be recommending to top this up. It was a great result, and the outlook is very strong for this company. but do it on market. Speak to your advisor.
As somebody in the industry told me, Ben, just reflecting on the result and the announcement, AirTrunk, which we know was the poster boy for the Australian data centres business, would crave the sites Goodman's got.
Yeah.
That's somebody very close to it. So, absolutely. Let's talk about some of the infrastructure stocks, Ben. They've been poor performers over the last probably couple of years. So we're talking about APA Group and the toll road operators, Transurban and Atlas Arteria. But they turned around on the back of good results, really, and it was actually results-driven activity.
Yeah, I think all three delivered quite decent earnings growth. It was a bit of a surprise, to be honest, Jeremy. And we know Atlas has had a lot of issues with France, where there's almost like a socialist bent occurring in the company with private businesses and tax grabs and these sort of things.
It's been going on for a couple of centuries, really.
APA was the highlight. That stock's still on a dividend yield in the high sevens if you buy it at the moment. And I think the analysts...
In a market hard to find yield.
Hard to find yield. I mean, this has been definitely a feature of this reporting season, is dividends have been under pressure.
Yeah, that was different this time.
Yeah.
And again, more like not because earnings, but being growth opportunities, reinvestment opportunities. So that was material. So infrastructure stocks, have another look at them, I think is what we're saying.
Yeah.
Let's go to resources, BHP and Deterra, talk iron ore, which... and then across the range of commodities too, Ben. But the iron ore story has got a bit complicated at the moment, hasn't it?
Yeah, I mean, the price is still around that $100, very profitable. There's a trade war now occurring with China. We don't know how long that's going to last, how severe it's going to get, how much it could impact on China, but everyone's a bit wary, I think. China is showing some green shoots, I would say. Their stock market's actually been the best performing market globally
really
this year. And they do have their 6-year meeting where Xi could come out and try and get things accelerating domestically. So, look, a tough environment, I think, for all the commodities guys. But ultimately, both these businesses still paying good dividends and very profitable.
Yeah. Macquarie Group, let's update. Aristocrat, same. Yeah. Both the companies tracking very well. Aristocrat particularly, is going well. Macquarie always gives something to like and something to be wary of. Yeah. And so that business is, obviously a large American operation too. So the next thing we're about to talk about is the state of the world and America. So, Macquarie, though, is still very well placed. Its share price has been not as strong as the retail banks in the last year, nor did it sell off as much. Yeah,
look, it's I think it feels like everyone in the market is still holding hope for tomorrow and a pickup in general M&A activity and corporate activity, which we were seeing, and it's a bit of one step forward, one step back. It feels a bit like at the moment, they're well placed on a leaner cost base to be much more profitable when conditions pick up. And Shamara was actually talking yesterday in Sydney, and we're about to talk about America. I'd really encourage anyone who's interested in this to get the Fin review from today, which is Wednesday, because there was a conference where we had the head of Blackstone, the head of BlackRock, the head of Goldman Sachs flew in for it, the head of Macquarie, very upbeat on America, despite what's the headlines today.
and let's dive right into that now, Ben, because so we would normally be doing just reporting season. We have to talk macro. We all watched what came out of the White House with the Zelensky press conference, which fills a lot of column space. And I think you're right to direct people to see what business leaders are saying, because in this game, there's a lot of noise at any time, but around a Trumpian presidency, more noise than you could possibly imagine. And everybody will have views on the person or what have you. What we have to follow is the decisions that are made, not the words. And there's a number of prisms where you can look through it. But I think when the business leaders of this kind are giving you a pretty clear read that these are good times for business, as investors, that's what we've got to be focused on.
Yeah, completely. We knew going into Trump's presidency, and we, if you could go back to some videos ago at the start of the year, that valuations around the world were higher than we've seen them for a while. So if I look at the share market, it was all priced for positive news. And Trump was saying he was going to do some things which we looked at and thought markets won't like that if he actually does it. And there are other things which markets will love. Yeah. And I think it's the surprise has been there just feels like there's three key planks to this plan. There's tariffs to readjust trading behaviour between two countries. There's cutting costs out of government. And there is ending the two major wars that are going on globally. And he's gone at like a bullet at China shop at all three simultaneously.
Yeah. And whether you like the methods, the ending of wars is, as was said here, ending the wars is good for business unless you're in the war business. Okay. Tariffs are universally bad for business unless they're a short-term tactic, which produces a better outcome. And that is quite naturally the positive uptick that could happen, and very much the art of the deal. He wrote a book about it. He'll tell you his game plan. And very much then taxes have risen across the Western world.
Yeah.
So his co-president, Elon, taking an axe to government and bureaucracy will be greeted largely by business.
Yeah.
So in terms of, yes, it's going to be a jumpy, busy ride, but look at what he's doing. And this morning we heard the Ukraine want now to sign the agreement they weren't happy to sign on the weekend.
It's moving around a lot, and I think our advice would be don't worry about the next headline because it can change a day later. And there's a lot of press. And the other thing is don't lose sight that a lot of these things in the longer term will be very beneficial to the US economy and share market. It's just that the shaking up at the start of it has got everyone a bit unnerved.
Yeah, that's right. Yeah.
The S&P 500 did 20% plus returns for 2 years coming into his presidency.
It's got to give up some ground now. It's given up a little bit here. I think locally from our peak, which happened to be Valentine's Day, we've given up about 6% in the Australian market. Without patting ourselves on the back, it's what we were sort of thinking would happen. We did say that in these insights. We did allocate more money to bonds and private equity and the like for that very reason. And yet we're still very optimistic about the positioning of this. And I think it's really important that people do not get carried away by headlines. Well, it's nice coffee chat, but it doesn't make for a sound basis for investment decisions.
Yeah, and you just on average, the S&P 500 has 5% corrections every year. That's over 100 years of data. And it has a 7% correction at least twice a year on average. So, we're going into March.
And we're batting really below average in recent times.
Yeah. We haven't had many corrections.
Years,
It's been hard to allocate capital to markets in the last couple of years. So, even if Trump wasn't around, there still would have been a reason for a correction at some point this year because we haven't had one for so long. So I think don't stress too much about it. And I'd also say that we're now seeing some decent buying opportunities across some of our holdings for the first time in a while, I'd say.
Yeah. After a good earnings season and a pullback in price, suddenly the buying list has grown and there's some value, which is actually we're really cheering it because it's been a lot harder. So there will be more changes. We'll be updating you again through the back end of March. But in terms of today, that's all we've got time for.